Good afternoon, everyone. Welcome back. Brad Macbeth here with the Simple Plan Live. Great to be with you. And today we're going to be looking at one of those very challenging topics. I'd love to talk about challenging topics. I hope you know that. There's a lot of things that people don't like to talk about. Death, taxes, whatever. We talk about them all here. And we come up with plans for all of them. So one of the things that everyone will contend with at some point in their lives, most likely, is a plan for long-term care. Now, you may or may not require long-term care when you're in your elderly years, but it's quite likely that someone in your family has or will need long-term care, whether that's parents, relatives of other descriptions, in-laws, what have you. It's fairly inescapable. So we want to look today at how we can plan for long-term care. A lot of people think that long-term care isn't something they need to think about, or if they think about it, they don't really know how to think about it or what to do about it. So we're going to drill right down into that. I want to thank our sponsor. That is the Simple Plan community. Come on and join us there, facebook.com/groups/Simple Plan community. It's free to join, and we welcome you. We bring your financial dreams, hopes, challenges, issues. We deal with them all there. We have tips, tricks, conversations. We answer everybody's questions, try to help out. It's just great to have a community to walk together as you're working on building your finances the way that you want to take care of your family. All right. So as I was saying, with long-term care, first off, what happens with long-term care is different from province to province here in Canada. But let me just clarify what I mean by long-term care. I'm talking about when we get to a place in life where we're not fully capable of taking care of ourselves. We need some assistance. Often that's measured through 5 or 6 activities of daily living, which include feeding ourselves, getting in and out of bed, using the toilet, continence, bathing. What's the other one? Getting dressed. That's the other one. Okay, so often at some point in time, as we age, or if we have some infirmity, we may well need assistance with some of those things. There's different places it can happen. Of course, you can stay in your home, which is usually the preference of many people for as long as possible, depending on their social situation. So, for example, if they're married, and their spouse is still living, then people prefer to stay together in their homes. And there's a range of options there. You can get care, but you're pretty much going to have to fund that yourself. And I'll get back to that in a second. The other options, of course, are to move into some sort of place that provides some assistance. Assisted living is the term that gets used here in my province of British Columbia. And in an assisted living facility, there is some care available, some medical care, limited medical care available, as well as assistance with all those things like remembering to take your medications, and those activities of daily living and all that, and there may well be meals offered and that kind of thing. And then you get into more long-term or extended care situations that are, a little more hospital-like in that they have full medical care for people that require more advanced support. And then one other level you can get to is what we call memory care, and that can take on several forms. Memory care is for people who have cognitive deficits. So they have some form of dementia or Alzheimer's or something that prevents their minds from functioning as fully as they once may have. And that can range from just support to being in facilities that are locked so that it prevents people wandering and getting lost. Now, in each province has its own ways of managing these things. I'll just give you the example here in British Columbia. In British Columbia, if you need care, They may well say, well, we have programs to help you stay in your home. And it's true that they do. The problem is the resources are extremely limited and very understaffed, which is an ongoing problem in health throughout healthcare right now. And so even though you may qualify to receive support to stay in your home, you will likely not receive that support to stay in your home from government-funded sources because there just isn't the staff available to do it. And so you can stay in your home, but then you probably are going to have to hire some private services to help assist with that. Whether that's you need someone to come in a couple of times a day to help you with something, or you need, supervision throughout the day or what have you. Now, if you do need to go into a facility, you're no longer able to stay in your home, then the way that works in British Columbia is that the government does fund some government rooms, if you will, or spaces, I think they would call them. But a lot of these spaces are actually in private facilities, and some of the spaces in the private facilities are subsidized by government. So what happens is this stuff is means tested. So when you go into one of these locations, you're going to pay a percentage of your income, a high percentage of your income. It's 90% of your income, up to a fixed ceiling, which I believe is around $4,500 or $5,000. So essentially, you're going to be paying out most of your income in order to pay for that space. Now, the challenge when you're going into a space that is provided by government is that you don't necessarily have a lot of choice. It would depend how rapidly the onset of your need came on. But, for example, if you're in a metropolitan area and you need to go into a facility, then you're going to go in wherever they can find you a spot. And that may not be close to where you live. And by that, I mean, it could well be, an hour's drive or commute away. Where that becomes very problematic is when you have an elderly couple. Folks can end up being separated. And the fewer choices you're able to make on your own, the more likely that scenario is. It's a recognized problem and one that's very difficult for the government to manage. And they certainly say that they, wherever possible, will accommodate couples, but facilities aren't really built that way. And so there are private facilities where you have a greater range of choice to age in place or to age in close proximity to one another if you need different levels of care. But for those types of facilities, you need to be able to fund that. And so what this really comes down to is opportunities and choice. If you want to keep your options as wide open as possible, you want to have some funding of your own for your own long-term care. And so I just want to show you today a couple of ways that we can manage that. Now, we used to be able to buy direct insurance for this called long-term care insurance. And it was a good option. Unfortunately, those options have really faded away in Canada. There's really only a couple of providers left, and the options that they're providing are not very good. So for people that have existing long-term care insurance policies, hang on to those. But you cannot get a good quality new long-term care insurance policy. They don't have really the kind of benefits and coverage that you would like them to have for the amount of money you have to pay for them. And another problem is that the premiums are not guaranteed. So you can start paying for these things. And for the one that most resembles a long-term care policy that remains in place, you have to pay for the rest of your life. It's life pay. And they can raise the premiums on these policies. So you could well get into a scenario where you've paid in premiums into this policy for years, and then for whatever reason, the insurance company finds that their claims experience is hurting, so they decide they have to raise the rates significantly, and then you find you can't afford those rates, and so you have to let your policy lapse after having paid into it for years. So not a great option at all. So what are we to do if we want to deal with this? Well, let me show you what we've been putting together for people who are looking for long-term care. Now this is a scenario generally where you're going to start planning for this. Obviously the earlier you plan, the better, but usually you're going to start planning for this around age 50. So what we've come up with is an approach where we take a couple of different types of insurance. Now, you could certainly fund this for yourself. So if you could set aside, say, $100,000 or $150,000 that you can comfortably earmark and say, we're not going to touch that unless we need it for long-term care, then great. You can certainly do that. But this is a way of doing that using a combination of insurance and a combination of insurances that kind of fit the bill for what you need in long-term care. So let me talk first. We use two components in this. One is critical illness insurance. And critical illness insurance is something that we look at because, and I'm going to do a more extended session on critical illness for everybody soon, but today we're just going to talk about it in the terms of a long-term care plan. But here's just some simple way of thinking about critical illness. We have a 1 in 1,165 chance of our house catching fire. But of course, and that's a fairly remote prospect, but of course we carry house insurance against fire because we really can't afford to suffer the loss that would come if our house burned down. You have about a 1 in 3,600 chance of being in a serious car accident. And yet, of course, we have car insurance for that. In fact, we're required by law to have that. Now we have a 1 in 12 chance that an individual age 40 dies before they reach age 65. And of course, we insure that with life insurance. Again, because it's a financial loss that we can't really afford. Now, we also have a 1 in 3 chance of Canadians have a 1 in 3 chance of experiencing a 90-day plus extended period of absence from their work due to illness or injury. And so they carry disability insurance. But did you know that we have a 1 in 4 to 1 in 5 chance of contracting a critical illness? And when we look at a married couple, that increases to a 40% chance in a couple. There's a 40% chance in a couple of one person of the couple contracting a critical illness. And now, what do we mean by critical illness? Well, here's a list here of what's covered by critical illness insurance policies. And you can see the top three there, heart attack, cancer, and stroke, are the three major reasons that people and coronary artery bypass surgery would be part of the heart issues. So it's those first four there that are the main reasons that these policies get paid out. But it does cover many other illnesses, as you can see there, multiple sclerosis, Alzheimer's, and et cetera, et cetera. And so these are great policies to have. You'll see at the bottom here, we also have something called loss of independent existence, which is I was referring to those 6 activities of daily living. If you are compromised in 2 of those areas of the 6 activities of daily living, that's considered a loss of your independent existence, and a critical illness policy would pay out as well. Also, many of those policies now pay out for acquired brain injury, something that happens can happen through disease or through a knock to the head. And if you are cognitively compromised because of that, then a critical illness policy may well pay out for that. So what we're looking at in our long-term care scenario is to provide for the ability to be cared for as we need to be, whatever our situation is. You know, if we've got one of those illnesses, well, our critical illness coverage will pay out for that. And but there may be other scenarios under which you need care, but you don't actually have one of those critical illnesses. And so we don't want to just leave it to critical illness insurance. We want to use that as a combination. And so what we're putting together now is a platform where people are covered for the critical illness, but also where they're covered for where we're accumulating funds in a policy that we can use for other purposes, other care purposes. And so in this scenario, we're looking at a premium of about $270 a month. And as you'll see here, 120 of that is going to critical illness coverage. And that's going to pay out a direct benefit of $50,000. Now, with critical illness insurance, there is a sum insured, a face amount insured, just like with life insurance. And if you are diagnosed with one of those critical illnesses, it just pays out that sum. So if you have a heart attack or you have a stroke or you get one of those other illnesses, as soon as that's diagnosed, the insurance company will pay you the benefit of $50,000. Now, bundled in with that is a whole life policy where we're going to accumulate some cash, so that what we're doing is we're saving money that we can get access to. The money's going to grow tax-free. We can get access to it tax-free through a policy loan if we need it and use it for long-term care. But in the event that we don't use it for long-term care, then eventually that policy is going to pay out the death benefit, which means all the premiums and accumulated growth will pay out tax-free to our estate or beneficiaries. So that means this is not a small sum that we're committing to this. It's a sum that we're going to receive back with growth, no matter what happens. So we may end up using it for our long-term care, or we may end up not using it in long-term care, and then it just pays out as a death benefit. So let's have a look at what that looks like. So this is our $270 a month premium. And so if we look here, what we're seeing on this chart is the amount that we're paying, that is the sum of the premiums, the insurance benefit, and the cash value. The sum of premiums is the red bars, the green bar is the cash value, and the blue bar is the insurance benefit. And so what we see here is that at year 12, age 61, so I'm using a 50-year-old couple here, and we're using joint last to die coverage for the life portion. The critical illness was just on the husband, but for the life portion, I'm using the joint last to die. And so what happens is by age 61, which is the 12th year of premiums, the amount of premium that's been paid is now exceeded by the cash value. So the amount of money that's accumulating in the policy is now greater than the sum of the premiums paid. And by the time we get to year 20, we no longer are paying any premiums. This policy is set up so that it's only a 20-year payment. So once we get to out to life expectancy, so let's imagine at age 75, there's a need for some long-term care. Perhaps one of the couple, perhaps the man has Alzheimer's. All right, so with Alzheimer's, now the critical illness policy is going to pay out its $50,000 benefit. Plus, there's another $55,000 in the life insurance accumulation, cash accumulation, that can be used tax-free to pay for some form of care, whether that's in the home or whether that's in some kind of facility. As we often see with people with cognitive deficits, there's a transition that takes place where usually or often they're cared for at home, but ultimately that becomes too much of a burden for the caregiver, and the person has to go into a facility of some kind where they can be properly cared for and supported. And so by age 75, you've got $55,000 accumulated in this plan, and you've got the $50,000 critical illness benefit. So you've got $105,000. Now, if it didn't happen till age 80, we're going to have $70,000 in there. If it gets to age 85, we've got almost $90,000 in the whole life plan, plus, of course, the $50,000 in critical illness, giving us about $140,000 to deal with this challenge. Now, let's imagine that happily both people don't require long-term care, and at life expectancy, so individual life expectancy of age 88, we get to and we see that now what's going to happen is the life insurance plan is going to pay out the $133,000 accumulated life insurance benefit. And that's remember we had a total life insurance premium of $36,000 that we'd paid, as well as our critical illness premiums. And so we've got $132,000 benefit that pays out once both people have passed away, because we set this up as joint last to die, and that's going to be paid out directly to your named beneficiaries. So your children, your grandchildren, your favorite charities, and that's going to go to them. There's going to be no tax payable on it, and it's going to go to them directly just within 2 or 3 weeks of your passing, as opposed to getting caught up in the probate of your estate, which could take many months, and the probate fees that go with that. Now, if one of you happens to survive all the way to age 99, age 100, then the policy is going to pay out $175,000, again, on the $36,000 in premiums that were deposited into this. So this becomes a very tax-efficient way to have access to the money. It's getting a great return on investment for the cash that's accumulating, given the security and safety of the investment. These dividends that are paid through these whole life policies have been paid out, in this particular company's case, nonstop since the 1930s. They've paid a dividend every year, and the current dividend rate is 6%, 6.05 actually. Longer term, it's been higher. But when we compare that with a conservative, secure investment otherwise, like a bond portfolio, well, bond portfolios have been generating 2.5% over the last 20 years or so. And so it's a good, solid investment value that's secure and gives you access to the money as you need it. So just to give you an idea of the return on the cash value, as we get into the later years of the policy, the return on the cash value hits up over 3% into about the 3.66%. Again, and that's there's no tax on that. If we either borrow it through a policy loan, which is a contractual right of the policy, or it pays out as a death benefit. Either way, there's no tax being paid. And so 3.66%, no tax being paid, is a pretty nice rate of return for a very solid investment. We can also look at the internal rate of return of the insurance benefit. So when it finally pays out, even if you live to age 99, the insurance benefit, the rate of return on that is 3.93% on the money that you've been putting into that plan. And then finally, because some people will say, well, why don't I just save the money myself? Well, there's two reasons. One is because, of course, you would have to accumulate that money for a long period of time to get enough of a nest egg going to be confident that it's going to cover you. Now, by all means, if you've got the net worth to do that, then that's fantastic. You know, if you've got a nest egg of $100,000, $200,000, $300,000, whatever you feel comfortable with, that you can just clearly earmark for long-term care needs, fantastic. But for the many people who aren't in that position, and let me just paint you a scenario, because this is a very common problem. We know that women generally outlive men by a few years. And so what can often happen is the couple has money set aside that they're living on in retirement. That's going along well. And then perhaps the man gets dementia or some other illness and requires care. Well, now, without a long-term care nest egg or plan set up, they start using the funds that they have for retirement in order to provide care for that person, whether it's in the home or in a facility. And that goes on for a couple of years. Typical period in care is about 18 months in Canada. And it goes on and it drains away a lot of their retirement nest egg, and then the man passes on. Well, that leaves his grieving widow with years ahead of her, but a substantially reduced nest egg because it's been undermined by having to draw money in order to pay for this care, not just provide for monthly living. And so that's a very common scenario where the partner, the spouse that's left behind, is left with a significantly reduced nest egg, and so their standard of living has to drop dramatically. And that's why it's so important that we have a long-term care plan in place, because it protects not just the ability to provide care, but it protects the integrity of the retirement income as well. Okay, so last piece here, because often people will ask, well, why don't I just save money? Well, let's just look at the accumulation. If we were just accumulating the money at 2.5%, right? So we can see the cash value here that we have access to, but also the death benefit, right? So as time goes on, the cash value far exceeds, so after 40 years, the cash value significantly exceeds what they could have accumulated at, say, 2.5%, a bond portfolio after paying taxes on that. Actually, that's without even paying taxes. So that's $77,000. They would be paying tax on that as well. And so it's very difficult, or just would require significantly more money to be invested in some cash accumulation in order to provide that. On top of that, we have the critical illness insurance providing an immediate benefit right out of the gate. So if we start this at age 50, but if at age 55, one of the partners has cancer, immediately there's going to be that $50,000 to help provide for any care needs at that point in time. And of course, if you end up not having to use the money for long-term care, which that's what we would hope for everyone, well, the insurance benefit that's going to pay out at, say, age 94 far exceeds, at $154,000, far exceeds the money that you could accumulate in a comparably safe investment outside of this type of a plan. That would only accumulate to about $87,000. So it provides great investment value as well as the ability to manage long-term care needs. So this is not a perfect plan. Unfortunately, there are no perfect plans. Things happen in life. But it's a very good plan, an excellent alternative for managing long-term care needs. And as we looked at the beginning today, it's very likely that someone in a couple, that one of you is going to need some form of care, and you really need to have something set up to deal with that. Of course, most of us have some form of experience directly or indirectly, either with our parents or our grandparents or people we know who are dealing with their parents who are aging. And we're well aware of the challenges that long-term care can bring. So I hope you found that helpful. I'd love to talk with you more if you're interested in finding out more on how such a plan might work for you. There's different ways of constructing these things. Of course, you can come join us in our Simple Plan community. We talk about all these matters there as well. stay abreast of everything that we're doing and subscribe to our weekly update at go.getthesimpleplan.com/subscribe. I'll put that in the comments. And you can subscribe to our weekly newsletter. Lets you know what's happening in our broadcasts week to week. Gives you access to tools, tips, tricks, and all manner of things. And if you want to know more, you are welcome to book a time to get together. We do a 15-minute introductory meeting. There's no cost or obligation. I just want to get to know you. You can get to know us. Happy to discuss with you whatever your needs might be and see if we can help you out in some way. But no pressure. It's not a sales pitch. It's just a get to know us and see if there's something that might work for you in what we do. We're here every week pretty much doing this. We'll be here again next week and looking forward to that. Until then, thanks very much for joining us. Do take care of your long-term care needs. It's essential, and the sooner you get started, the better off you'll be. Thanks very much for joining us, and we'll see you next time.